Welcome to the deep dive. You bring the data, we help make sense of it. Today, we're hitting the gas, doing a custom deep dive into the U.S. auto manufacturer sector.
Yeah, a really high-octane space right now. We've basically screened things down to the three big U.S. names getting the most attention, volume-wise: Ford, Tesla, and newcomer RIVN.
Exactly. And our mission today, to sort of synthesize all this data, we've got basics, technicals, valuation, financial health, and the latest news, all based on the close for September 26th.
Think of it as your shortcut through the noise. We're trying to clarify what's really driving these companies in this massive industry shift.
And we're adding a little twist. We're calling it the paper money challenge.
Right.
For each of these three, we're imagining a hypothetical $10,000 investment here, placed exactly at their 52-week low price. And we'll calculate the paper profit or, loss on that as of today's close. Bit of fun with numbers. But before we jump into all that green and red, the important legal bit.
Absolutely essential. Look, we have to be crystal clear. This is purely journalistic. It's all based on public data, meant for discussion, for educational purposes.
Not investment advice.
Definitely not investment advice. We're just talking about hypothetical paper money performance based on past prices.
Yeah.
Nothing about the future.
Okay. Got it. So let's kick things off with the stalwart, the legacy player trying to navigate this new world. Ford Motor Company, ticker F.
Yeah, Ford. Classic name. NYSE S&P 500 component. Closed at $12.01 recently. Had a pretty good day, up over 3%. 3.36% actually. And look at the volume, huge.
Yeah.
Over 117 million shares traded.
Wow.
But what really jumps out first with Ford, I think, is the value side of things.
The value argument. And by that, you mean those fundamental ratios look pretty low compared to others.
That's exactly it. You look at the price to earnings, the PE ratio, it's sitting at 15.32, which is, reasonable.
Yeah.
But the forward PE, looking ahead, it drops to just 8.59.
Okay, 8.59. So the market's expecting earnings to improve relative to the price.
That's the implication, yeah. It signals, the market sees it as more of a mature, maybe lower growth story compared to, say, a tech stock.
Yeah.
And even more telling for value, folks, is the price to sales. It's just 0.26.
0.26, that sounds incredibly low. What does that actually, signify for the listener?
Well, it means the market isn't putting much of a premium on Ford's actual revenue. Every dollar of sales Ford makes is valued, let's say, pretty modestly by the street.
Okay.
Contrast that with high-growth tech, where PS can be 10, 20, even higher. So Ford's ratio, it suggests maybe some skepticism about rapid growth or high margins, but it could also signal it's undervalued if they pull off this EV pivot.
And financially, they do have that big carrot for some investors.
Yeah.
That dividend yield, it's quite high, isn't it?
It is. 5.57%. That's a significant income stream. But, you can't talk about Ford's transformation without hitting the flip side of being a century-old manufacturer.
Yeah.
The debt.
The leverage.
That's the big caveat here. While you get the income, they're carrying a lot of debt. The debt-to-equity ratio is 3.56. That's substantial.
Meaning more debt than equity financing the company.
Significantly more, yeah. And the long-term debt-to-equity is also high at 2.28. Now, their gross margin is, 7.09%, but the actual profit margin, it's really thin, just 1.70%.
So high debt, thin margins, that's the legacy way. But looking forward, what are the projections saying? Is there improvement expected?
Well, that's the potential turnaround story. EPS, earnings per share, was actually down significantly this year, nearly 36%. But the forecast for next year is a big rebound, projected up 18.36%.
Okay, so analysts see a bounce back. Does the technical picture support that sort of optimism?
To some extent, yes, especially short-term. The RSI, the Relative Strength Index, is at 62.70. That shows pretty strong buying momentum.
Getting close to overbought, though.
It is approaching that 70 level, yeah. So it's something to watch. But for trend followers, the moving averages are definitely positive right now.
Ah, the SMAs. What are they telling us?
The price is trading nicely above the 20-day, the 50-day, and the 200-day simple moving averages. When you're above all three like that, it's generally seen as a pretty solid technical buy signal across different time frames.
And performance-wise?
Pretty decent recently.
Yeah.
Quarterly gain of over 11%, and year-to-date it's up more than 23%.
Okay, let's bring in the news flow. Sounds like a bit of a mixed bag. Short-term EV benefits, but maybe longer-term pains?
That sums it up pretty well. You've got Ford hitting 52-week highs, partly boosted by people maybe rushing to buy EVs before that $7,500 federal tax credit potentially expires or changes.
Right, end of September deadline rush.
Exactly. And they're trying to innovate, showing off that new $30,000 electric pickup platform. But then you see the other side, Cutting jobs up to 1,000 in Germany for their EV operations. They cited weak demand in Europe.
So managing this huge shift, launching new products, but also dealing with demand issues and restructuring costs, it's complex.
Very complex. And analysts are kind of split too. The average recommendation is basically a hold, and the target price is actually below where the stock is trading now.
Yeah.
You've had recent downgrades, but the stock has been strong.
All right, time for the Ford Paper Money Challenge. Our make-believe investor drops $10,000 into Ford at its 52-week low, which was $8.44. What happens?
Okay, so 10K at $8.44 buys you, let's see, 1,084 shares.
Okay.
As of the recent close of $12.01, that hypothetical stake is worth $14,218.84.
Meaning a paper profit of?
A paper profit of $4,218.84. That's a 42.29% gain on paper. Not bad at all for the legacy player. Shows there's still potential there.
A very respectable return. Okay, now let's shift gears dramatically. We move from the legacy value play to, well, the market behemoth operating in a totally different financial reality. Tesla, TSLA.
Yeah, talk about a contrast. If Ford is about value and managing debt, Tesla is all about that massive growth premium, future tech bets, AI, the whole narrative.
And the scale difference is just staggering.
It really is. Tesla's market cap, around $1.46 trillion.
Wow.
It just dwarfs Ford's, what, $47 billion? And RIVN's $18 billion combined. It's incredible. Shows the market's belief in its disruptive potential. Closed recently at $440.40. Also had a strong day, up over 4%.
Okay, the valuation metrics. You warned us about Ford's. Tesla's must be different.
Oh, yeah. Prepare for sticker shock. Ford's PE was 15, remember?
Right.
Tesla's PE, 255.
255. Okay. That's not just a number. That's a whole different investor mindset, isn't it?
Absolutely. It's pricing in just enormous future growth, technological dominance, maybe even things beyond cars like AI and energy. The price-to-sales ratio is also high at nearly 16.
So investors are paying almost 16 times current sales for the stock. What's the growth expectation driving that?
Huge expectations. They project EPS next year to jump almost 44%. The market's basically saying we believe sales and, more importantly, margins will be way, way higher down the road.
It's a bet on the future, pure and simple.
What underpins that confidence, though, especially when other automakers seem to be struggling more? It's really the combination of the narrative and a very strong balance sheet, financially speaking.
Okay.
Tesla is remarkably low on debt. Debt to equity is tiny, just 0.17. They have loads of liquidity, current ratio over 2. This gives them immense flexibility, right? They can fund growth, weather downturns, innovate, without relying heavily on borrowing.
And profitability. Unlike Ford's thin margins.
Tesla's profit margin is much healthier, around 6.54%. So they are making decent money on what they sell now, even with price cuts.
But there are some warning signs, or at least signs of pressure, aren't there? Can't ignore the recent slowdowns.
No, you absolutely can't. And that's the crucial counterpoint. For all the hype, EPS this year is actually projected to be down over 28%. And sales quarter over quarter actually fell nearly 12%.
So when a stock is priced for perfection, like Tesla is...
Exactly. Any wobble, like slowing sales growth, gets magnified. Competition is heating up too.
Okay, turning to the technicals. I assume with that price action, the momentum looks strong.
Oh, incredibly strong. The RSI is right up near 70 at 69.58. That's very high positive momentum, lots of aggressive buying.
And the moving averages.
Miles above them. Price is way over the 20, 50, and 200-day averages. Confirms a really powerful uptrend. The one-year gain is over 73%.
But with that kind of move comes
volatility, big time. The beta is 2.06. That means it's basically twice as volatile as the overall market. Moves are amplified both up and down.
And the news flow seems to constantly reinforce that tech narrative, right? AI, future stuff.
That's what fuels the valuation story. You see analysts like Wedbush recently raising price targets, talking about $600, framing Tesla less as a car company and more as an AI play.
Right.
News about patents for the cybercab, the robotaxi concept, feeds right into that. But again, the counterpoint is competition. Reports suggest rivals like BYD are actually outselling Tesla in key markets like Europe now.
Okay, the big reveal. Tesla Paper Money Challenge. $10,000 invested at the 52-week low of $212.11. What's the outcome?
All right, so that 10K at that higher share price only buys you 47 shares.
Fewer shares, but higher price.
Exactly. At the recent close of $440.40, that hypothetical position is worth $20,698.80.
Wow. So the paper profit is?
A very significant $10,698.80. That's a 107.63% gain on paper, more than doubled the initial investment. Clearly the winner in our challenge. purely based on buying that low point.
Shows the power of catching that volatile upswing. Okay, finally, let's look at the third player, Rivian Automotive, RIVN, the electric challenger, and maybe the speculative bet.
Yeah, that's a good way to put it. Rivian, market cap around $19 billion, closed at 15, plugged at 59, down slightly on the day. This story is completely different again. It's all about future potential versus, well, pretty significant current losses.
And there's a lot of tension in the stock itself, right? Short interest.
Huge short float, nearly 21%. So roughly 1 in 5 shares available for trading is being bet against by short sellers. That's very high. But interestingly, insider ownership is also really high, over 37%. Lots of skin in the game from founders and early investors.
So it's a battleground stock. And financially, unlike Ford's value or Tesla's current profitability, Rivian is, well, it's tough reading, isn't it?
It is. They're deep in the red. You can't even calculate a PE because earnings are negative. EPS is minus $3.23 per share. Profit margin, negative 68%. They are burning through cash rapidly to build the business.
Okay, so burning cash. But they're not necessarily about to run out, are they? Explain the liquidity situation for the listener.
Right, that's the key distinction. Despite the massive losses, they have a huge war chest of cash. Their current ratio is very strong at 3.44, quick ratio at 2.72. And importantly, they have about $6.19 in cash for every share outstanding.
So that cash hoard gives them time, a runway.
Exactly. It gives them a long runway to fund operations, build out that huge Georgia factory, develop the R2 and R3 models, and hopefully reach profitability down the line. Sales are growing up 12.5% last quarter, but profitability is still, years away likely.
And technically, how's the stock been doing? Does it reflect that hope or the current losses?
Lately, it's reflected the hope. The stock's had a strong run, up over 31% year-over-year. The RSI is high, 66.97, showing good momentum. And like the others, it's trading above its key moving averages, SMA 20, 50, and 200.
So trend followers are buying this story.
It seems so. But again, high volatility. Beta is 1.83, so it moves around a lot, similar to Tesla in that regard.
What's the news keeping this narrative alive, despite things like recalls or layoffs?
It's all about the future product pipeline. Breaking ground on that massive $5 billion factory in Georgia is a huge statement.
Yeah.
And all the talk is about the upcoming R2 and R3 platforms. Those are meant to be their more affordable mass-market vehicles. That's the story the market's buying into.
Even with recent analyst downgrades and that steering recall.
Yeah. Seems like the market's looking past those for now. They had downgrades from Guggenheim, Jefferies. The recall involved 24,000 vehicles. But the overriding sentiment seems to be that Rivian is kind of the supplemental Tesla play, the main challenger in pure EVs, especially in the truck SUV space.
Okay, let's wrap Rivian with the paper money challenge. $10,000 invested at its 52-week low of $9.50.
Right. At $9.50, that $10 that $10K gets you 1,052 shares.
A decent number of shares.
Yeah. And at the recent close of $15.59, that hypothetical holding is worth $16,399.88.
Okay, so the paper profit here is?
A paper profit of $6,399.88. That works out to a 64.11% gain on paper. Very strong return. Again, highlighting the momentum it's had off those lows.
So pulling it all together, this deep dive really highlights 3 incredibly different paths within the same U.S. auto sector.
It really does. It's a perfect snapshot of this huge industry transformation. You've got Ford, the legacy giant, wrestling with debt, trying to pivot, offering income but facing transition pains.
Then Tesla, the absolute outlier, commanding that massive growth valuation fueled by low debt, AI promises, tech narratives, despite some operational speed bumps.
Right. And then Rivian, the pure challenger. Burning cash, yes, but using a big war chest to fund ambitious growth. Operating deep in the red, but with huge market expectations pinned on future execution.
And the big theme cutting across all 3 is this massive, sometimes painful shift to electric vehicles, isn't it? We see it in Ford's job cuts, Rivian spending.
Absolutely. And short-term things like that EV tax credit deadline we mentioned are definitely adding fuel to the fire, maybe pulling some sales forward across the sector.
If you just compare the financial structures, Ford's high leverage, Tesla's high liquidity and low debt, Rivian's cash-rich but loss-making position, it's fascinating.
It is. And here's maybe where we circle back to you, the listener, with final thought.
We mentioned earlier those insider transactions recently. We saw some selling from leaders at Ford and Rivian during this run-up, but we also saw Elon Musk making a significant buy in Tesla shares in mid-September.
Right. So when you see stock performance and news cycles potentially influenced by these insider moves reflecting either confidence or maybe taking profits, it raises a really interesting question.
how much weight should you, as someone trying to understand this market, put on that kind of ownership activity, that insider psychology, versus the cold, hard numbers, the
Yeah,
financial metrics like PE ratios, debt levels, profit margins?
yeah, finding that balance between understanding the sentiment, the psychology, and grounding it in the fundamental data, that's really key to navigating these complex shifts, isn't it?
A really provocative question to think about as these auto giants race towards whatever the electric future holds. That's our deep dive for today.